Hello everyone, this is Marshall Gidler bringing you the morning comment for December 12th. Investors continue to struggle with the implications of lower oil prices. Are lower prices good for the economy because they mean more cash in the hands of consumers? Or are they bad because they mean less capital spending and employment in the oil industry? Personally, it's clear to me. I own a car but no oil wells. So lower oil prices are an advantage for me and I assume for other consumers who are in the same condition. As consumers spend their money on other things besides gasoline, then other companies will invest in other things too, such as auto manufacturing plants. And the economy should keep on growing. No? Of course, things could be different in a zero marginal cost economy. If consumers spend their money on music downloads instead of filling up their cars, then maybe server farms will have to expand, but the effect on the economy probably won't be as great as drilling more oil wells would be. Now, as for the action, the Australian dollar dropped sharply after the Reserve Bank of Australia Governor Stevens told the Australian Financial Review that it's quite likely that the Australian dollar would be lower a year from now. He also lowered his target rate for the Aussie to 75 US cents from 85. It's around 83 now, so there's still plenty of downside. Other commodity currencies were also under pressure as oil prices fell. Dollar CAD reached a new high for the year, as Bank of Canada Governor Paulo said that Canada's labour market still shows considerable excess capacity. Most emerging market currencies were also under pressure, led by oil producers Mexico, Brazil, Indonesia, and of course today, the huge collapse in the Russian ruble. Oil importing currencies such as the Singapore dollar, Korean won, and Taiwan dollar fell against the US dollar as well, but nowhere near as much. Now today's market is a little calmer, with the big exceptions I mentioned of the ruble. Sweden's unemployment rate for November came out as expected and had very little impact on the krona, which was weakening into the figure. In the US, the headline producer price index for November is expected to have risen 1.4% year on year. That's a slowdown from 1.5% in October, while the core rate is forecast to remain unchanged at 1.8%. That shouldn't be a major market mover. The preliminary University of Michigan consumer sentiment for December is forecast to show a modest rise. Now, Sunday will be the Japanese lower house election. The overall result isn't really in question. The ruling Liberal Democratic Party, which is neither liberal nor democratic, is certain to win. The only question is how big a victory they'll get. They currently have 294 seats in the 475-seat House. If they get a two-thirds majority, or 317 seats, then they'll no longer need to rule in a coalition with the Komeito Party. In that case, the government might change its focus to Prime Minister Abe's social and political goals rather than his economic goals. That could be bad for stocks and therefore send dollar-yen lower. On the other hand, if they remain in power through a coalition, then his victory would strengthen his hand in dealing with the Ministry of Finance and with those in his own party who oppose his third arrow of structural reform. That could be good for Japanese stocks and therefore send dollar-yen higher. Now, a substantial loss of seats would be the biggest surprise, and that would probably send both stocks and dollar-yen lower, as it could endanger his reform policy. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX Global, wishing you solid trading.